Introducing the 3-part options course with Hans Albrecht. Get access for free by scanning this QR code or clicking on the link in the description.
Hey, greetings everyone, and thank you so much for joining us. It is Macro to Micro Options Power Hour. I am Samantha LaDuc, founder of LaDucTrading.com, joined by Hans Albrecht, our options mentor, trader extraordinaire. He is actually coming from the West Coast. I'm on the East Coast, and we're looking at post-Wednesday, April 30th earnings review on Mag 4 of the 7 tonight and tomorrow. Big sentiment, big fundamental expectation for these heavy hitters. But we also are dealing with some gyrations in the market, which is exciting from a trading standpoint, but can be a little nerve-wracking. This morning we had a negative GDP print, but in fact, if you break out the imports that made a big one-time impact, it actually was a positive print. So the initial knee-jerk reaction was sell off. This was before market opened. Luckily, I run a live trading room and I thought it was really too much too soon. So at 10 o'clock, it turned. That was expected. We actually bounced very strongly and even into the end of the day. So we had a really nice little rally from 10 a.m. on. And now we're really just trying to get through the week, which is, of course, headline driven, but also jobless claims tomorrow morning, as well as non-farm payroll on Friday before I go to next week. Also, Bank of Japan has their meeting on Thursday evening before we go to FOMC next Wednesday. So long story short, we're still grinding higher. A lot of sectors that are going nowhere fast, but the market itself is still supported. Bonds got some support. Dollar stopped falling. Oil right now has been really weak and pulling yields lower. We're going to talk about all of this stuff, some sector rotation. We'll take your Q&A in Zoom Q&A. So basically it's ask us anything. And I'm going to turn it over to Hans to give us a rundown. Since we last spoke, we were on the fence going, we're so headline driven. We're waiting for the next big thing. And right now we haven't received any news on peace deals, any news on trade deals, any news on tax cuts, but they are getting closer. And that is also the pent up frustration and also anticipation of market bulls and bears. What do you see, Hans?
We've seen an easing of fear levels, of course. We've been talking about this for a while, these very large ranges that we've seen that played into part of this almost existential worry that we had down around 5,000, 4,900, which was taken off the table. So we've taken off that sort of no one cares about us, large premium to volatility, and it's coming quite a bit. We've seen skew really coming quite a bit lately, which is very interesting. So if you look at some measures if you look at COVID, for example, some of those skew measures stayed pretty bid for a good amount of time, maybe a year and a half into even after things started to rally back. So we've seen that relax very quickly. So almost kind of shades of what we've seen over the last few years, which is very big bounce backs. And August was a huge example of that. This time, not as much, but where people have been talking about how this can't be a V, it's going to be more of a W or some other letter that you can pick, maybe an S, or I don't know what it's going to look like. But we are getting a little bit of a V in some areas. So the VIX really coming down. But interestingly, over the last week, we haven't really seen a drop in fixed strike vol. So for folks out there who are like, what the heck does that mean? It just basically means when the market moves around, remember that the market can ride up the skew, the market's implied vol skew, which is higher to the downside. So when the market goes down, it rides up those more expensive puts. So it's not really indicative necessarily of people scrambling and buying protection, just be moving down into an area of the options market that just happens to be priced higher. And so that makes the VIX go up, but it's not necessarily going up, it's just getting to that higher level of VIX. So that's what makes the little nuances. We talked a little bit about that last week with Brent, how there's sort of little nuances and little things that you can identify under the hood. When you see fixed strike, which means those strikes actually have higher implied volatilities themselves than they did yesterday, that's when there's durable fear. What we've seen over the last week is that those fixed strikes haven't really come down very much. That's a sign that vol's found a happy level. So probably going into Mag 7 earnings, going in some of the data that we've got later on this week is the reason for that. But volatility's found a happy level. We're getting some big moves still, right? We're seeing some big moves, 1 to 2%. That's still a VIX 30 plus kind of environment. So 25, 24 is starting to get a little bit cheap for the time being. Now, we are also seeing realized volatility come in. So we are not seeing those sort of breakneck moves that we saw a little while ago, a few weeks ago. And that's playing into a sense of calm, and that's helping to bring the VIX down as well. So very interesting area. I've been talking about in the community this morning in the Slack. So I'm commenting and helping members out at LaDuc. And I said, listen, I think it's going to be a buy the dip sort of environment. I think we've taken off that sort of very panicky reflex move potential to the downside with the Trump put, with the bond put, with the Trump put now, the number of flinches that we've seen. And so we're now in an area where I think the market is saying, okay, when can we start to look past some of the problems? I'd love to hear your thoughts on this, Samantha. I do in your rooms and everything, but I'd like to hear it today, of course, on the show. The market can potentially, of course, so everyone's starting to talk about, look, people are buying stuff, they're loading up inventories, they're stocking the pantries again, right? So they're buying lots of things. So the data is going to be a little bit skewed and not reflective of reality, potentially, the reality of tariffs and rising costs and things like that. And so they're saying, forget about that. Third quarter, we're going to start seeing some softness. We're going to see reality start to set in from an economic standpoint, from a data standpoint. But I think it's at that time that we're probably going to see a whole bunch of deals. There's talks about India, talks about various deals brewing in the background, which adds to positive headline potential, which is also why the market is a little bit resilient here. There's this expectation of a little bit of a trickling in of good news over time. And so that's where we're at. Maybe we get to a point where the market starts to look at and say, look, 2025, forget about it. It's a throwaway. Let's look to 2026. Let's look to tax cuts or whatever, an extension of the existing tax plan. Let's look to regulatory benefits. Let's look to AI starting to create productivity advancements in businesses across all areas of the economy. Let's start to look to that. So I wonder how much is going to be considered if the market starting to say some of this is going to be transitory. I love that word, transitory. Jay Powell put that in the lexicon now, transitory. And when the market senses that something's transitory, you can bet that it's going to say not that important anymore.
For right now, I think that this is still a bear market rally. And I know that many are excited about all these thrusts. There are three in particular kind of making their way through FinTwit. I'm not really into that particular approach, but it is something that technically gets bulls very excited. I think that all of those key breadth thrusts coincided with policy intervention. So my lens is always policy intervention. What do we have coming in for keeping the market bid? We had a very strong pullback, obviously 21.5% for SPY into that 48.78 SPX, very key level, right, which I had been projecting early and often. So this bounce that really formed on April 9th was policy intervention. It was Trump talking the bond market into calm, but most after a major rout in yield spikes on the 8th, right? But it was really policy intervention by Trump coming in and saying, hey, wait a minute, we're really just going to delay this for 90 days. So give it a breather. And obviously shorts had to cover. And then slowly it started to percolate higher because the market was basically pricing in a Trump fold. Some are bullish by nature, just always expecting the best, the peace deals, the trade deals, the tax cut deals. And while we're waiting, we're getting a lot of headlines, which is tons and tons of noise, but we don't have any actionable meat. Nonetheless, we're climbing that wall of worry while folks are very well hedged. So the max pain would be we get up and through that 57.50 and they start to cover those hedges. I think after they cover the hedges, it's going to be a slam dunk short because the structural problems, the functional and fundamental issues aren't going away, but it is an absolute grind higher. And so we really, right now, we're getting aftermarket, Meta and Microsoft crushing it. Tesla did very poorly, but they got bid back up because of well-timed White House announcements, and they're still a cult stock. And Netflix beat. They're also quote unquote tariff proof along with Spotify. But the point is, we really still have an earnings sweet spot where the bar has been lowered consistently week after week for companies to be able to get over. And now we're going to be looking down the line at Q2, their guidance, their estimate. But right now we're also in the sweet spot as it relates to the dollar crashed. It didn't just fall 10%. It crashed and it has stopped crashing. Very helpful. Yields stopped rising. Very helpful. And basically we have daily, not weekly, daily interventions speak by Besant and Lutnick and not Musk, he's done, and Trump. So I think this is part and parcel for the timing also of volatility. So I have to show you something because I think this kind of helps a little bit as far as framing why I had some of this bullish bent. But here is, for example, okay, so Monday morning, I updated this bullish bent continues for clients, and this is in my Slack Market Thoughts channel. Lots and lots of reasons, but in a nutshell, I still see this SPX 5633.27. It's a gap fill. We're going there. Now, of course, this morning we had a knee-jerk reaction lower that got bought, but the bigger thing is I still see VIX falling from last week. Once we got back inside a key level, I saw VVIX falling into 93 and VIX falling into 20. So let me just show you what that looks like. Okay, so this is basically a trend line where I came up with 20. It's not rocket science. It's also the 200-day. So once we actually came inside and broke the March high, this is very important. Remember the March high we talked about? We did the webinar right before options expiration and said, and I was like, it did a 2-bar reversal at 29.56. So anyway, I technically will analyze VIX, even though it's a reversion to the mean index and it's not a price per se like a stock. I don't care. It still works. Anyway, once we got above that, it was obviously hot fire flames in April and we got walloped right into that 60 mark. But the point is this has been fading. And once we got back inside 29.56, which was last Wednesday, this was really a tell that this whole realized volatility is going to soften right into expiration. And this is really coming right back down. We had a little bit of a shake right here, which is today, but you can notice on the intraday, since it's the 1 hour, that's the day, and that's the weekly, you can notice that this morning when we popped up here, I said, I don't trust it. It's too much too soon. And it wasn't about the GDP negative print per se, dissecting it to say it's not real. It was about this is too much too soon. I still see the next bout of volatility coming in once we come back down here to 20. So I think that was too much too soon. And literally, I literally said by 10 o'clock, you'll see puts monetize and this will come back in, break 29.60. You can see this 26.93. And come back in, and that will be very market bullish. And then what you've got right now is this, which is, again, looking at VIX and VVIX coming down and giving clients a way to navigate this. You can see what happened today. We were literally, I'm like, this is it. This is where it's going to come down. This is where it's going to stop and start moving higher. And this is the same thing with SPY. That's Qs, by the way. And the fact that we have not spiking yields, right, and not crashing dollar is also right now correlated to support for equities. Also, gold stopped going up last Wednesday, something we also talked about, and we were talking about it with Brent as well. Anyway, that coming down has also allowed equities to get a breather. So hopefully that is technically sharing, a little bit of how I looked at the bullish bent is still in play, even though we are absolutely susceptible to hard data coming in and interrupting the bullish flows. I still see a short-term bullish mode. Let's get through the mega cap 4 earnings this week, 2 more tomorrow. Let's see how non-farm payrolls it will deliver, but I'm not expecting any big surprises. And we could do this dance into sideways to higher until May expiration.
Yeah, you're probably right. It's almost just a lack of very bad news as opposed to just suddenly a lot of good news. And that's how markets can react sometimes. It's that we reacted very extremely to the downside, and because the market had this sense that there was this self-destruct button being hit, and it didn't like it, obviously, and for good reason. And so until that bond put came in, there was really this sense of, we've talked about in the past, where volatility starts to go up and it doesn't know where it's going to stop until there's some sort of impetus, right? Like you always say, if there's some sort of intervention, something happens and then puts in that top there. And that's a really big thing. In the meantime, it has no clue. It prices in things that you didn't think were possible. So now we've taken that off the table, and now perhaps there's a bit of a waiting period. I've been telling people that, listen, we probably trade, I think we could get maybe down to 5,200, 5,250, but then we'll probably trade in a range here until some sense of what's happening to companies out there, what is actually really happening to earnings. Some reports of consumer spending being fairly okay right now. Now, sure, some of that is buying things that maybe ahead of tariffs, and there's definitely a big part of that. So I think if we can acknowledge that there's going to be some period of slowness after that, following this sort of period of buying up a whole bunch of stuff, I think the market can kind of look to that. As long as some progress is being made and some deals are being made, I think the market can start to start to handle that. Now, will we go into a recession? I'd love to hear your thoughts on it. Are we going to go into a mild recession? Are we going to go into something a little bit worse? If that's the case, then I think you have to say a multiple of 15, 16 is probably a little bit more appropriate. So there's almost like this game of chicken being played. If some positive things happen, then the market is probably generally okay, because I think there is a little bit of paralysis there, right? So I look at, see all these charts, a lot of data by Slock, all these people coming out with these things showing things falling off a cliff, and confidence falling off a cliff, and spending falling off a cliff in many ways, and minimum credit card payments, just all this terrible data. But I think you have to concede that some of that is this almost like a bit of paralysis out there, because we don't know and we need a little bit of clarity. And so people say, I'm going to put off that vacation for now. I'm going to put off that purchase for now. It doesn't mean they don't have jobs and that they don't have the means to purchase these things. They're just holding back. So I think you have to take some of that data with a grain of salt, and hopefully some positive things start to happen. If they don't, if we go 6 or 8 months and the destruction continues from higher prices, it's happening already, right? This Amazon Prime Day, they're saying, a lot of sellers are saying, I don't have any deals to give people. So that's a very real thing. It's repairable, but it needs to happen relatively quickly.
Let me just share a chart, because someone just asked as far as particular levels, and then I'll comment more on the macro backdrop. But this is, okay. So this is SPX, right? Somebody asked about how far is this puppy going to go until they smack it back down for good reason with hard data or a missed fire trade deal, peace deal, tax cut deal. But the point is, we came down into this 48.78, which was really critical support. We had our day of intervention right here on April 9th. We held above a critical level of this kind of 52.65. Even though we overshot it, we came right back in. Again, that's the market we're in, where we gap down and then we get bought. The point is, we have definitely started to move higher. Today, we actually got caught with a pullback that got obviously defended at 10 a.m. on time. And 1, 2, 3, 4, 5, 6, 7 days. 7 days straight green, right? Closes. Very bullish as it relates to the grind. The bid is still getting put in there, and there's a little bit of liquidity. I talk about that often, which is another tell of mine, which is this indicator right here. We got back above the yellow line, and now we need to go back up in E-mini above 5,600, which is the April 2nd gap down. Anyway, the point is, that's all the technical stuff of how we got supported. And as far as where we could continue higher, I've got, and you can see on a weekly, which is why I really like to go out in time, I've got this 56.70 area, overshoot to 57.62 area. Doesn't mean we're going to stop there, but that's definitely where I would expect it would digest and really get tested. Now, the problem is we really don't have bulls, the heavy shorts that are protected for really good reasons, covering unless we get and stay above that kind of 57.62, right? So they're going to hold their hedges. They're going to expect this big left shoulder, big head, big right shoulder kind of alley-oop, and then head back down to 4,800, push through to lower levels. So this is really where we're going to start to get, I think, a test. 57.62, 57.50 area, just for a level of this bounce before I start looking for something else. Bigger picture, we still have a massive amount of risk underneath the surface with falling dollar and with lots of deals that could fall apart. But when you were just talking about what's causing this market excitement, the market is not pricing in recession. Like you said, they're waiting, fundamentally speaking. They don't know how these companies are going to price in what's happening. And the trade impact is severe. BlackRock is already calling a recession a few weeks ago. Apollo, you were just referencing, says we'll have one by summer. Anyway, the point is they really don't know how to price in an unsustainable trade war with China. They hear behind closed doors admitting it's an unsustainable trade war, and they're trying to de-escalate. Just keep in mind, they escalated in the first place, they meaning the Trump administration. So how receptive China will be to this is anyone's guess, but they don't need to be. And so I'm on the other side when people say, oh, they have to agree to US terms. Oh, no, they do not. And we have the great privilege of having a classical economist in Jeffrey on our trading desk who knows emerging markets, therefore the debt situation we have, and who also knows China better than anyone. So no, they do not have to do a deal. Anyway, the point is we definitely have money going home, which is, again, part of it's the feature, not just a bug. And this is going to continue. I don't think this is going to be resolved just because Mag 7 beats. But the market is definitely pricing in Trump folding or some type of deal. Congress also potentially overruling tariffs. So I forget who is leading the charge there to basically, remember, Trump has signed like 141 executive orders, 5 of which have been made into laws, and 200 lawsuits just in his first 100 days. The man has been busy, and he's also had a lot of pushback. But the point is, this is something that the Congress could overrule. I don't know the odds. I don't know Vegas odds. I'm just saying this is part of the equity bullishness, right? And then, of course, the Powell capitulation. Many are expecting Powell to do a normative cut, not an accommodative cut, but a normative cut. So this is what I'm really looking for as reasons why the market rises in addition to option flow. And then I'm looking for real economic consequences that are coming in from these tariffs, just like you were alluding to. And one of them is jobless claims above, it's actually 267,000, but in any case, we're not there yet. We're 222 for like years. So we need to really push this up higher and sustain it in order for real recession risk, not perceived, but real. And then pointing to your Apollo mention, this is the slide deck that I posted on Monday, which is, yes, they are pointing to the sharpest decline in earnings outlook since 2020, which, by the way, makes it easier for them to jump over. But Meta, I will admit, crushed it. Not surprised. Anyway, we'll go over those in a minute. New orders collapsing, sharp reversal in corporate CapEx spending plans. Prices paid are absolutely rising. Consumer confidence isn't just at record lows, it is shocking. So again, this is what they say. What they're doing is they're front running lots of orders. In the meantime, we have behind the scenes, Meta is crushing earnings and they're still holding up the market until the next de-risking or unwind. And that could be from a yen carry trade. That could be from another sovereign debt shake and bake like we had on April 8th. It doesn't mean the coast is clear, but we've definitely been given a gift from this bounce, in my humble opinion.
We have. It is a gift, and it'll be interesting to see the flows, money going wherever it's going to go. If it's still going to continue to go east, leaving home or going home rather. So that'll be interesting because if they take the opportunity on this bounce to really step it up and continue to sell, that'll be interesting. I have this feeling that some may reconsider. I don't know. You may think it's a bit more durable. It's certainly something we haven't seen in a very long. Definitely a massive shot across the bow for U.S. assets. There's no question about it. I wonder if there's a reconsideration at some point, which could add a little bit of fuel from the bullish stance. Right now, so some of the things that I'm looking at and important for option trade, sometimes we talk about this implied versus realized volatility, right? So implied is the basically option pricing and realized is how much are things moving around. And so the idea with options is you're trying to gauge, is the insurance cheap? Expensive? It's expensive, you can sell it and scalp that. It's a kind of a carry trade. If it's cheap, that's when you can go long options and potentially use that leverage to your advantage. And right now, everything's coming up as cheap, but that's where you bring in that sort of extra sense that you should have as an option trader and realize that it's only cheap because we're coming off of such incredibly high realized volatility. So we saw daily ranges at GFC levels. We've seen incredible amounts of movement. Meta, here we are back at 575, went down to 485, back to 575, back down to 500. Now it's back at 575. These are unbelievable moves for massive multi-trillion-dollar companies. So the volatility has been off the charts. And so that's what, if you look at a chart like this, if I can make this a little bit bigger, this is something that like a quant who wasn't actually trading might look at this and go, look, implied volatility is really cheap versus realized volatility. But you have to be very careful because that realized volatility is reflecting what happened a few weeks ago. And it is set to really come down. So that's always the risk, is that you think options are cheap and they may not be that cheap if we continue to trade in a much more reasonable range. So that's where you look at something like this and you go, okay, I get it. Everything looks cheap, but you have to temper that a little bit with the idea that it's a relative relationship, right? It's option pricing versus movement. And if movement is starting to kick out data of insane, remember we had those 8-10% moves, we start to kick out data like that, then this picture starts to change a little bit. So I think that's an important point to make. We can see, oh no, I've got everything zoomed in. Here's cross asset volatility. We can see things really relaxing as we've taken doomsday off the table here. We can see gold vol, which was a little bit high. I've been talking to members about doing gold iron condors and things like that, given that, and I like to do things like that once they reach a level. And we've talked about this in the past on MSTR and some other things where, as things are starting to go parabolic, that's not the time to get in the way. You want to wait till it finds a level, it finds a little happy place that it can either find a bottom or a top. Then you can step in and play some of those short vol strategies like an iron condor, maybe credit spreads of that or something of that nature. So we're seeing a lot of these volatilities come down here. Credit as well. I think we've seen the credit spread sort of situations improve as well, Samantha. So that's going to probably put people at ease a little bit more as
For
well.
now, for now. So
now.
I have a strong opinion about credit spreads since I called that in February and they widened 200 basis points. They're coming back down, but they're going to get busy again in July. So
I'm going to change your middle name to For Now. It's going to be Samantha For Now LaDuc. And then it's like, oh, for now, hold on a sec, for now, because you're always giving us these great things to think about from a 40,000 foot standpoint. And it's hard when you're trading markets, you get stuck in that noise, and it's good to sometimes step back and go, hold on, this is what we're potentially looking at over the next few months. So some of the trades that I've been putting out have been things like broken wing butterflies, because when you have a market that has this very high level of option pricing in it, you can, as things rally back, you see a compression of volatility. So on Meta, I've got a couple of interesting stories here on Meta. So first of all, on earnings,
First of all, you own Meta. This is part of your core, isn't it?
Yeah, I love Meta. I own it. I own it a little bit higher, but I've been trading it all over the place. And when it was around 600, and this is what I've been telling people, when you get these higher levels of implied volatility and particularly realized volatility, I think a lot of people focus on option pricing and sometimes they forget about realized volatility. So that's that sort of second option metric that you really need to keep track of, because when realized volatility is pointing straight up, that means you're still in the storm, right? You may have high option pricing that you want to take advantage of in terms of harvesting it, but when you're in the middle of the hurricane, you have to be careful. So you want to wait for things to show some sign of a slight bit of calm at least before you start to wade in to those kinds of trades. And in that kind of environment, I think you go from cash secured puts to credit spreads. You want to have that little bit of extra protection. When Meta was up around 600, I sold a 545.35 put spread. And because we were starting to get in that higher level of concern, I thought that was fairly safe. Guess what? Meta plunged. It flew right through my credit spread. It got down to the low 500s. But what I like about that trade is you have a little piece that you can play with. So I'm short the 545 put. I'm long the 535. So when it got down to 510, I said, okay, I want to own Meta. I don't mind owning Meta. So I'm going to remove the long put. And I made a bunch of money on the put that I had bought. I was underwater on the put that I sold. And I rolled it down. Sorry, I didn't just sell it out. I rolled it down to 465. So then Meta started bouncing around a little bit, went back up, went all the way to 575 again, then came all the way back down, and it dipped under 500, and I sold the put that I rolled it to. So I sold the 465. So then it got back by the end of the day today. I said, okay, I'm going to cover this short put. I don't want to carry it into earnings. I have another structure that I'll tell you about in a moment. I want to just take this off because I've actually made money on it. Idea, and this is how I present to people. I say, listen, when the market is moving and things are happening and the VIX is 25 or worse, that's where you want to do things in a defined risk way, which is what a vertical will do. The credit spread will define what your risk is. Plus, you have that little piece of long gamma, which means you can play the movement that you're seeing. And that's what I did with that. So I sold the long puts twice, and I did the calculation earlier. I made $34 on the long puts, and I lost $14 on the short put. So all in all, I made $20 on the whole trade, which was good, right? So it's a trade that went wrong, but I was able to salvage it by having that little extra piece, that extra put that I could play with as the stock moved back and forth. And of course, all levels were very high. But I didn't want to keep it through earnings, so I got rid of it. However, what I did do into this earnings print is I picked up one of these broken wing flies. So what I did was, I have it here, risk profiles. What I did was I created sometimes with these flies, people will set them up with equidistant strikes from that middle strike. But what I like about the broken wing is that you can create something that costs you a little bit more at the outset, but gives you that guaranteed win no matter how high it goes, which is a downside to a regular fly. Is if it blows through the whole butterfly, then you really haven't made any money, which is frustrating when you make a good call on direction and you don't make any money. So I set this up and I had it lopsided like this. And one of the other benefits to it, we're going to see how it plays out tomorrow. Meta up quite a bit today. We may see a compression of volatility, which is normal. After earnings, you see those option prices compress in the short term. This is a May position. So, if I had an 8-month position, it probably wouldn't come down very much, but it is a very short-term position that is going to get compressed. And the nice thing about one of these positions is you have long delta, right? That means you're going to make money as it goes up. So you're making a call on direction. You're going to benefit from that delta, but you're also short Vega where it matters. So I'm short the 590. The stock's now coming up into 577, 580 after hours. And I'm going to see this P&L be better than what we're seeing here. Because if I want to really see what my P&L is going to actually look like tomorrow, I have to make a little bit of an educated guess as to how much volatility is going to come down, which it will, it should. And so it'll drop probably 15, 20 vol points. I didn't look at what it was at the close, but it should come down. So I'm going to make money on Delta. I'm going to make money on short Vega, and that's going to really fit into this kind of move. Because otherwise, if you just go into earnings and you say, we're just going to buy some calls, the next day you come in and you haven't made any money or you've lost money and you've gone, wait a minute, I was right. Well, that's because they really juiced those options going into
and
those
in
events.
fact, today, we talked about this. I really expected Meta to beat, but it has a 7% expected move. So where is it sitting right now? At the top of that 7%. So it's still inside the expected range. And the same thing, Microsoft, they both did well. This is not the surprise. In answer to your question about NVIDIA in Q&A, thank you. I'm like, looking where QA, chat, they're all over. Yes, I expect that we'll have a different market into NVIDIA on the 29th. I'm bullish NVIDIA until I know it's chopping to higher. 96 is support. It needs to get above 106 to make it to 116, to make it to 126, to make it to 136. So for me, I've got them in incremental $10 channels. But the point is, I still see that moving higher, and then I do not expect it to be bullish after that. NVIDIA has earnings on the 29th. Options expiration is right before then. I think we will hold together, as we've been talking about for several weeks, quote unquote, going nowhere fast or big sideways swaths of, because we had this 600 to 653 point range for the first week, the second week, third week, it got a little bit more compressed. The last week, it was also pretty wide, but nowhere as large. It's not going to beat the monthly candle that we've had. Basically, that monthly candle is astoundingly wide, and we're going to stay inside that for a while. So there's no reason that I see that we're going to take the top out or the bottom out in the next month. I think we're just going to continue to grind sideways to higher until we get those levels that either spark the bears covering their hedges, or they're right, they're going to hold right through it no matter what. But for right now, I think we're still waiting for that kind of Memorial Day weekend, NVIDIA earnings, and May expiration to unleash any further real kind of volatility of size.
Yeah, exactly. And so sometimes these moves can go on a little farther than you think they can go. And you've got this VIX. 20 is probably not a bad spot. I like your call on that. One thing is I see that
it could go lower. My point is I saw it falling into, and I kept last week I had a level, and then on Monday I updated it. So I said, no, I can see VVIX falling into 93 and VIX falling into 20, and then let's see. So it could still drop 20, but that would only happen if we get some positive news, number one, and number two, that would trigger VIX falling underneath that 20, which would trigger a whole bunch of those puts unwinding. So that has to happen for me. Otherwise, we're just gonna 20 is the next level. I'm gonna say, let's look then. Let's see then.
Yeah, and that's the thing. You've got the term structure starting to get happy again. And I know that's hard. Yep. Sometimes it's hard for people to see that because we've had to rally 600-700 points in order to get to the point where we're saying, oh, now the VIX term structure is saying everything's calm. But that's the way volatility works, right? When you're in the midst of this, is basically showing you that first month versus second month future, which when that front month future is higher than the second, it's a sign of disturbance, there's a disturbance in the force, right? People are very nervous about things. They're very panicky in the short term. So this is starting to unwind a little bit. So we could very well see once we backwardate like this, then that's usually a sign of maybe some more durable fear, which is exactly what we had. Now, not always. Sometimes we get whipped and we head back up. This time it just got ugly. But if we start to get back to this level here, we may need to get back to a slight contango before things get ugly again. There may have to be a complete withdrawal of the levels of fear that we've seen before we potentially head back down into some sort of the reality of economic numbers and earnings and things like that. But for
No,
now,
peace
as I said,
trade and peace deals, trade deals, and debt ceiling / tax cut deals. If we see that, where we have this kind of relief rally of size that will include, I think, some shorts unwinding. If we do not, this is instant short at will, kind of like when we were live on April 2nd and we're looking at the futures market and we're like, it's going to tank. That was perfect. If we don't get the tax cuts passed, it is in essence a tax hike. We would be very quickly into sell-off mode again in a New York minute. Like, it would be very clear. That's not what they're going for right now. They're trying to get their ducks in a row there with trade deals that will offset some of the tax cuts. But we already are used to the tax cuts. So if they aren't followed through, then there'll be a hike. So that's the problem. We have risk, but right now it doesn't look like the market cares about any of it. We're still pricing in resolution of those things: peace, trade, and tax.
Peace, trade, and tax, and minerals, and Ukraine minerals, if they can pull that off as well.
That's part of the trade. So that's part of the peace. That's part of the
peace.
That bundle of peace trade is the Ukraine minerals, which is, again, that's a lot of noise, but definitely armistice. Ukraine and Russia is not noise. And then anything related to trade deals, which is China-based. Lots of other countries are not going to pull anywhere near the weight or remove the worry. As much as we love doing business with India, it's more the people than the products. And then ultimately, we just got to get through this raising of the debt ceiling and the tax cuts passed, because if it doesn't happen, we will be in recession regardless. So that's what we're looking for, is relief rally from those macro event risks.
And it has been, I have to say, the rally in MAG has been very impressive, right? So we really there was a reluctance for MAG to take part in all this. And this is finally, they've broken it open here, and they've gone bananas to the upside a little bit here. So except for not everything, right? NVIDIA is kind of, I'm a little bit negative on NVIDIA. I don't think it has a lot of upside. I'm a little bit negative on Google as well. I think they're under serious threat. I think you're seeing that. You saw this nice pop on terrific earnings, and then it filling right back in. I'm nervous about it. I own some, but I sold a whole bunch when it popped up there, and I just think there's
Google or NVIDIA?
For me,
NVIDIA is only a trade. I am very bearish, big picture. But as it relates to trade, this is such a huge weighting in SMH and related are so key to the Mag 7 and SPX cap weighting and NASDAQ. We can't ignore it. So I'm very focused on NVIDIA as it relates to the next time they will disappoint. But for right now, it's still bid. It's not falling apart. So
yeah, it's still bid, but the story. And so I keep telling people, look for charts to improve, and I'm seeing some improvement. I like that chart you showed on the SPY. See that sort of breakout above that line. So we pulled back to the 9-day EMA today, which is one of my favorites. I think you've got the 8 on there. So I think we can bounce between that 9 and that 50. And as long as we stay above that line, I think it's an area where maybe you can trade around this a little bit and not worry. As I said this morning, I said, I think we're going to buy the dips, and we did. I think it remains that. I think there's still people, as I said last week with Brent, I said, I think there's just more of an unwind of that bearishness that needs to happen. We don't know how long that can last, but maybe VIX 20 is potentially the level there. I've been trying to focus on good things like a Netflix, like a Costco. Covered some credit spreads in Costco today. So just trying to stay in those good charts, in those areas where I just feel like there's some positive storyline and the charts aren't broken. I don't really want to get super long. Like you said, I don't mind playing for a bounce in a broken chart, but it is just a trade. It is just a trade. But for anything
you're
else,
not chasing Weight Watchers coming up from 10 cents to $1.10? Oh my goodness.
I missed that one. Damn.
Please, it's okay. It's okay. That's hedge fund factor rotation coming in and covering their protracted downtrends there. They've made
Oh my goodness. Who's still short at 10 cents? Who would be still short at 10 cents? That's
there you
funny.
go. All right. Oh, sorry. Go ahead. I was just going to say.
And I was just going to say a few other things. MSTR. I think options have been. I've been talking about that for $100. The options have been cheap.
I know you love that.
But I was wrong. I thought the options would explode to the upside. That's typical for that area. We saw gold go parabolic. Option vols exploded, and this time it's happening in such a measured way. This MSTR is a very interesting kind of move because it's far outpacing coin and some of these other things. So it's just marching up, almost like something's brewing. But I think those options options are still cheap. So if you're looking to have a little bit of short option, long option, look around. There's a few things that still remain relatively inexpensive that have that potential to really move. And then Hood. I'm liking Reddit. I put on an interesting custom fly today, a 132 fly on Reddit that kind of gets me doing quite well if it runs up $15 to $20. So just trying to get creative in the option space, but recognizing that with volatility, with option pricing still relatively high, you've got to be a little bit careful and do some spreads, right? As opposed to buying a call, maybe buy a call spread, because when the stock runs up, you're going to have that compression of volatility, and you want to make sure that you've got a short piece up there that's going to benefit and shield you against some of that. So you can get a little creative, and you do things for a little bit less money with spreads as well. But I'd say in this environment, credit spreads on the short side, long spreads, long debit spreads to the upside or to the downside if they're puts. And I think as a hedge right now on SPY, I think somebody mentioned it today, a downside broken wing to the downside in SPY. I think that's interesting. The problem with downside flies is you can get that expansion of volatility, right? The VIX goes from 25 and it goes up, then that can hurt you from the perspective of that short Vega. So they're not as good to the downside, but I think a sell-off isn't going to come with that run that we saw in VIX. I think we could see a sell-off to 520, to 5,200, 5,100, and maybe a VIX 35. We're not going to see a VIX 60 again. I think we're going to see something much more measured. I think you need something to break again, right? Or a significant plunge, right? If the market really has a down 5% day, then yes. But I think if it's a bit more measured.
I think that's coming, but not, as I've mentioned, until Q3. But let me just, I grabbed the SPY chart because this was way back in December. Basically, we kind of hit sorry, I'm on that wrong. This is February. There we go. Do you see the February 19th high that I'm pointing at right now, which is ironic?
Yeah.
Okay, we ran into the 200, which is this green level. I threw a fib on there just to see how far, right? And we came into and threw past the 127 fib extension before that very explosive bounce on the 9th. But the point is, this was also March. We do these every Wednesday. It seems like on Wednesday it stops going up. Literally, February 19th, the March 25th, and then of course that April 2nd was also a Wednesday. Anyway, my point is, we're finally in positive gamma just now. And you can see right here, 1 hour, you can see the aftermarket hours. It does not show up on the daily or the weekly chart. But the reason why I'm doing this is because you can see the extent of this massive move. We are finally in positive gamma, long gamma, after the close, after the strong earnings from Microsoft and Meta. First positive reading since February 21st. Which is way the heck up here. Isn't that fascinating?
Yeah.
First time.
And you're going to get more. You'll get more of that, Samantha. So as the market gets up to 560, 570, you're going to see people start to, they're going to start selling anything. This VIX will compress nicely and perhaps give us yet another opportunity to pick up some less expensive options. I like to see the VVIX under 100. I prefer to see it down around 90. That's where I get a little bit more excited about protection, because then the cost of the vol gets lower.
Yeah, this is where I had basically last week when I said VIX is going to soften, that's going to put support in the market. I'm still leaning bullish. And even though we had a shake and bake today, you know what happened intraday, got completely unwound. Same idea with the VIX. I've got VVIX. Look at this gorgeous trend line. It's coming to 93. So now if it breaks 93, you know what's going to happen. Those hedges are going to start to close. Those who are positioned in protective mode, because they don't know what's going to come out of the peace trade, the peace deals, the trade deals, or the tax/debt ceiling deals. But the point is, yeah, we definitely have some fading lower levels, but I think that's fine. That's fascinating. Anyway, the SPX that I had given was here, this gap fill, 56.33. And once we get above 56.33, we're going to head up to that 200 day again. And once we get above 200 day, it's going to trap a lot of bulls, because this is still a market underneath the surface that does not have the same policy intervention backdrop that we've had in 2023, 2024. We just don't have it. But it's not worth shorting, getting ahead of it until we have a reason. So don't panic until we have a reason. But I definitely do not expect anything above 60.50 kind of highs. I think we'll get back into the 50s, 750. We'll maybe overshoot to 58, 78. But I think this is definitely where we're going to have credit come back in, VIX come back and remind us that it's not so safe. But I don't think we have as much drama during May, but we'll see what happens after NVIDIA and end of month into June, July.
Yeah, as we get into that longer gamma, and as I said, I think we'll get even more long gamma because you're going to get all the funds selling calls and replenishing the dealer coffers. So that creates a bit of a walking through the mud scenario. So you can expect volatility to come down a little bit, which again, to my point earlier, be very careful when you're looking at some of these option pricing, thinking they're really cheap. They may get a little bit cheaper. So be very careful, use those spreads where you can. I was going to ask you about your growth to value chart.
I will. Let me first show you that credit spread deal. See, remember how we had started to percolate higher? VIX rose up to 60. But this literally from February into the April 7th or 9th, I forget which one, it actually moved 200 basis points. It's coming back down, which is bullish the market. As it comes back down, again, technically speaking, I'm expecting it to retest this trend line. And that's what we're getting. We're getting a NASDAQ composite to really move off that 200 week. We're moving right back into the prior 2023 early highs, which I know that you can't see this right here, but it's about 19,000. So composite NASDAQ, if this works the way I'm seeing it, this is the left shoulder, this is the head, this is the right shoulder. And the only way you're going to convince me that this is a bull market is if we get all of these things that I just talked about done and we get and stay above 19,000 on NASDAQ composite. Otherwise, I think we have some risk of surprise toward the end of 2025.
Now, I noticed somebody in the chat asking about the service. I don't know if you wanted to mention anything about that. They said, I was thinking of joining. Can you tell me about the service?
Yeah, we've got live trading rooms. We got Hans. We got 10 contributors from macro to micro and posting trades and supporting clients. And it's everything. But you could definitely reach out for more details. So I'm not doing a commercial to support at LaDucTrading.com, and they will definitely walk you through everything. And I thank you very much for asking. And Hans has a course, actually several courses for those who are learning options, beginning, intermediate, advanced. And we all provide a lot of hand-holding, but that's also for edge clients that want more interaction daily. Otherwise, you've got just a fabulous bench of day traders, swing traders, trend traders, macro traders, options, of course. Yeah, it's all in there. I'm not quite sure if we're missing anything. We got an oil trader. We got a bond fixed income specialist. I think we got it covered. I really do. I don't think there's anything that we have left unturned as it relates to asset classes and timeframes. So yeah. Sometimes it is hand holding. For example, on that NVIDIA, a client who is at a loss, and I'm like, I really think it's going to move higher into earnings. So if you want to hold off on taking those losses, I really think we're going to have a little bit more support. And so that's the kind of hand holding, right? Sometimes it's really clients that are way deep in gold and silver, and they're doing way phenomenally well. It's also managing, now they can't sleep at night because the position's too freaking large, right? And they don't want to lose any profits. So we got all kinds of support that we provide, but check it out. Email James at support@LaDucTrading.com and LaDucTrading.com/Hans for option courses. So right now, everybody's feeling really good, right? That things are looking up because the market is up. We have this bullish backdrop with earnings. That's good. That's fine. But we have to maintain this bullish bent. And right now we do have hard data coming in. I don't want anyone to get too comfortable, right? We got jobless claims that could start to percolate higher, and FOMC, a Powell who could say, go pound sand. We're not even thinking about cutting rates. And the market is definitely pricing in rate cuts. There's no question.
Inflation expectations are soaring.
Yes.
Soaring.
Yes.
So that puts Powell in a very difficult place. But we'll see the shelter component come down. I think that's a big influence. That should be positive.
Yeah.
But
PCE also is, again, some of this stuff is because of shelter is lagging, and then inflation comes down. Unemployment, you'd think it's rising with Doge cuts and such, but in fact, it's the denominator because of deportations. So you have the kind of the labor slack picks up and that unemployment rate does not spike higher. Anyway, there's a lot of ways to lie with statistics as well. We really don't know what the data is for real, but you know it. You do not know if BLS is even working because they keep telling us it's 222,000 jobless claims every Thursday for about 3 years. All right. But one of the reasons why I think yields have been falling, and I am right now on a monthly chart, we have been just huge range for stocks and bonds, but we need to get into some more clarity, which will be as we get closer to this debt ceiling debacle or a debate. Do they have enough votes to raise it? That's fiscal stimulus continues to support the equity market. And of course, tax cuts doesn't mean anything. It's not like we're going to gain from that, but it means obviously mostly corporations are not going to have the hit of a tax hike. So the point is, we don't have a lot right now of reason to get too bullish or too bearish. It's a bear market rally. Enjoy it while it lasts. Make hay while the sun shines. Enjoy earnings. It could be the last one for Q2. We know we have enough liquidity in Q1. We know we have enough earnings momentum in Q1. Q2 is going to look a little bit different with the trade war impact starting to hit in the next 30 days, 60 days. And then Q3 is where we haven't priced in potential consumer hit. So perception right now is they're scared about jobs 6 months out, right? And all that. But we haven't actually had hard data that shows they're scaling back and they're liquidating, et cetera. What has been clear is money is going home. So foreign investment in the equity market is clearly liquidating and leaving. I got lots of data points on that. That one I track really closely. But that's also the reason for the dollar falling. Anyway, gold is still bid, but big picture on a trend. But in the short term, it's softening, which is also helping support equities. And then, of course, the animal spirits, when they see a release like Meta and Microsoft, which by the way did outshine its expected move. So I think Microsoft had like a 4.14 expected move. It's up. It's up. So the point is we definitely have the animal spirits.
Yeah, it's back to 420. It was down to 350. It's back to 420. Some impressive rallies from our mag friends for sure. That's going to make a few people feel good. And those are heavily weighted, right? Well, they're heavily weighted in the volatility index and in the markets. This is going to set things up very interestingly. I've got some short upside call spreads in SPY, so I don't want it to get going too far. But we'll see a compression of vol into that move probably, unless it's too big. If we see a massive move, then the VIX may not come down as much as you think, because upside movement is still movement. So the vol market is always fun, many nuances, and those are some of the things that I look at and we look at LaDuc. So always happy to help people out. Members, check us out, definitely.
Oh, and I just realized it's, of course, Power Hour is Stella's Feed Me Now. Yes, again, oil, however, is still very much a short. Gold softening, animal spirits back in NASDAQ. I think we start to see more weakness again in that post-May timeframe. We'll be here every week, 4 o'clock. Check us out. And next week is FOMC. So let's see if we have any shake and shimmy from a Powell at the podium who either punts or panders. We don't know which, but we'll find out, and we'll do it next Wednesday. Thank you so much for joining. Cheers. Bye.
See you guys.
Subscribe to LaDuc Trading YouTube channel for more macro to micro options power hour and other content.